And I'm very happy and pleased to tell you that I have a very, very professional guest on the show today. Someone who actually, I would say, I guess, wrote a thesis about housing. Someone that actually knows what they're talking about when it comes to the current housing market and its global effect. And someone that actually understands how to read charts and could feel the markets and where they're trending to. So I would like to keep him under wraps because I don't want his because he has a lot of influence, and I don't want to give him up or anything. So Mr. X is on the show again. He was on the show a few years ago, or a year ago, or 8 months ago. I'm not too sure. But thanks for coming on. Hello.
A pleasure.
Thank you for being on the show. I appreciate it very much.
So what do you want to talk about today? What aspects of the market are you interested in today?
Well, we need to start with what is happening right now in the condo sector. Let's say you were talking earlier about Vancouver. What's going on in Vancouver?
Well, BC as a whole is having some really interesting things happen. Obviously, we've seen the stress test related to mortgages across the country become more of an issue. We've seen interest rates climb over the last few months. We've had the cleanup related to illegal money being funneled through casinos. We've had them clamp down on taxation related to capital gains that were never declared assignments. We've now seen, and this is the big one, we've now seen that they are now penetrating the corporate veil or looking through trust entities to actually show the foreign ownership and force foreigners to actually pay the foreign tax.
Oh.
While documentation for a long time has only shown, 10-15% foreign ownership, a lot of it has been held through trusts and corps in the past.
So, what do you put the number at?
Oh, I wouldn't even dare to wager a guess, but it's significant.
It's significant. Because I don't know if you remember the Better Dwelling article I read. I don't know how many billions of dollars in real estate that are foreign owned in Vancouver and Toronto. It was astronomical. There's more foreign ownership in real estate than Canada's debt.
And what's interesting about that is you start looking at the advantages of putting it in a corp and a trust. You avoid PPT, you avoid a variety of other taxes. If you're a foreign owner, there's a great strategy related to having your lawyer registered in his address and basically manage the corp. So as a result, most of the tactical investors from foreign nations have been using these corps to avoid this taxation ever since it's been put into place.
But this does not benefit the Canadian proper, because they're the ones that are kind of fitting the bill or are paying the bill, right?
Oh, I very much agree with that.
So now, where do you see things headed now? Okay, let's take a step back to the whole casino laundering thing. I covered that a bit and had some video footage from I think it was CBC, and then a little bit from Global, and a little bit from different footages with people bringing in these duffel bags full of money. And I just wanted to know what your thoughts are on that.
Well, yeah, I mean, there's a lot of nuances that I'm not privy to and are beyond my scope of knowledge, but as I understand it, there is substantial scale behind this. It's a great way to either launder drug money, launder foreign money. A lot of foreign nations now have restrictions on how much money you can pull out of a country. So people do things like buy Birkin bags and, incredibly expensive purses and bottles of $50,000 bottles of booze, and then return it on the other side or sell it for a fraction of what they paid for it in order to have liquidity on a foreign nation's soil. And then it's an easy way to launder it through the casino and declare it as gains.
Yeah. So yeah, I hear you on that one. And that's I mean, whatever happening to the day when people would open a nail salon or some furniture store and it would just sit there empty, but they would still layer their money through slowly, pay their taxes. What's the rush of liquidating money so fast?
Well, I mean, there's a variety of motivations here. I mean, immediately I'm thinking of China, of course, and they have a pretty tight clamp on how much money is allowed to leave the country, right?
Mm-hmm.
So I can't speak to their motivations, but I know that there's a lot of motivated investors and motivated high net worth people looking to place money in a variety of ways outside the country to try and mitigate their local risk.
Interesting. Okay, so now let's take another step back. What's happening with the condo market? Let me see if I have an article up here we could touch on here. I got the big story of the day, which is New Zealand bans foreigners from buying property in effort to clamp down on house price growth. Now, if that was to happen in Canada, how much of a change would you see? Would you see a change in Canada if Canada was to pass a law like this?
I think the question would be, is it designated as retroactive or proactive? And that plays a major role in the swing of the market. Because if you look at it in the terms of like, when Cuba took over their country and did recognize the ownership of the American property holders, when that happened, that crippled the market. It flooded a ton of supply into the market, and effectively, it went to centralized government for the most part. In that case, yes, it's absolutely structural change. It becomes a major significant thing. If you're talking about proactive, as in going forward, only assets that transact in the future, that may become relevant, but it won't become a significant thing overnight. And most economies can kind of bear that weight over time. And ultimately, it will probably result in a flattening of the increasing price, but it won't cripple the market.
Okay. That's a very interesting, very realistic look on it. I always look at the worst case scenario and take that and run with it because, I'm so used to, always seeing some of the worst things happen from time to time when it comes to markets, right?
And don't get me wrong, if there's enough speculation fluff in the market, it can see a short-term downside. And, when I say short-term or a certain percentage, you're only looking at, 10, 20 typically, whatever effectively represents the bloat in the market at any given point in time.
I like how you say that, actually. That's a very professional way of saying it. I haven't heard bloat in the market in years. I haven't heard anybody say that in years. Okay, so I just want to touch on this really quick. Montreal's real estate market is getting super hot, and it's spawning a rare bidding wars are happening in Montreal. Have you seen or heard about what's happening up in Montreal?
Well, I mean, I've read articles saying the same as everyone else, but in terms of why, I couldn't speak to the motivations. It is interesting to know that, with the cost of the type of constructions required for those temperatures, and with the civil law versus the common law, it does create some dynamics that are quite different from most of the rest of Canada.
Yeah, for the rest, yeah, definitely. Let's move on. I had something here on the condo market. Where is it? Oh, here it is. This is the one I wanted to throw at you right now. Vancouver condo inventory jumped 66%. Largest monthly price decline since 2012.
Specifically, they're talking about volume, correct? All the articles I've read is in regards to the volume, not the pricing.
Well, this one's largest monthly price decline since 2012.
Well, and that's not a huge surprise. The only thing is that ultimately we don't have a huge supply and demand imbalance in the city of Vancouver, and that's where it gets really tricky. Is that we actually are undersupplying the demand relative to people moving to the city, and that causes a real problem because even if you look at labor costs, land costs, material costs, none of those costs are really going down. And even if land costs did go down, for most of these high rises and mid rises, it represents 10, 15, maybe 20% of the total value of the project.
Actually, you missed a very important one: zoning laws.
And zoning laws, it plays a huge role in this. So what happens is that unless you flood the market with an increase in supply, you'll see a flattening of the market, and this is really where Vancouver is kind of falling into a cycle that we talked about a little earlier. It's falling into a cycle just like the last time the NDP came to power. Historically, Vancouver's looked like a staircase as a market. You have a really strong run, NDP comes to power, and it just flattens right out until they lose an election.
And do you think prices will go back up after the NDP get taken out, or what?
Well, I mean, I think it depends upon whoever takes back over changes the legislation or becomes more relaxed with the finance terms. Really, ultimately, we're in an overheated market. You look at who can actually afford to rent these units once they're complete at $3,000 and $4,000 a month, and all of a sudden you start going, okay, well, even the top 10% of the population has a tough time hitting that debt service or hitting that rent rate.
Yeah.
Well, now you've got a problem, because if you look at every pyramid of sales, you want to be targeting as wide a base of customers as you can.
Mm-hmm.
And if you're down to the last 10% being able to afford that market, either wages have to dramatically rise, which is starting to show signs because there's such a severe labor shortage, people don't really have a choice. But then most regular businesses, the food cost goes up, the daily living cost goes up, and it ultimately chokes out most other industries.
Oh, for sure. So my question now, let's touch on the labor. I did a video recently about the huge labor shortage problem. I've spoken to a couple of developers, web developers, software developers that have anywhere from a staff from 8 to 25 to 35 people in their staff. And they're looking to move to Maple Ridge and Hope, even Merritt, because they're having people will flock to the jobs if the money's there, but they won't flock to a job if they're underwater when it comes to paying bills.
Well, and that's one of the reasons why a lot of people are seeking secondary markets. You look at the Kelowna coming back for the first time in a long time. Kamloops coming back with some vengeance. You look at Victoria, and the rate that the rents have risen in Victoria is astronomical in the last 2 years.
Mm-hmm.
So it's a rush to secondary markets, because the secondary markets, they still want to live in BC, they still want to live in the West Coast, but they want to try and avoid that cost of living. And that's why Victoria is starting to see the growth of the tech sector, but you're also seeing it in a variety of other places as well. Basically, there comes a critical point where you become a city like Monaco, where,
Well, Monaco's a principality.
Exactly. Where not a lot of people can afford to be there. And basically, if you are there, you're in the super rich classification.
So you think...
Or you're serving.
Do you see Vancouver becoming a playground just for the rich?
I don't think NDP will let that happen. And they're being very tactical and closing a lot of major loopholes to make sure that doesn't happen. The problem with any rent ceiling and any cooling of a market by synthetic methods is that it's not a long-term solution. You look at rent ceilings in New York. I mean, every first-year economics class teaches about rent ceilings and trying to manipulate the market. As long as supply and demand is in an imbalance, it won't fix the problem.
Okay. Yeah, I touched on that. I think it was two weeks shows ago. We were touching on that and looking at different markets. We're targeting more of the New York market. Was looking at that right now, and they have a lot of stock that's coming on the market that still hasn't broke ground. They'll be hitting the market by 2020, and they're looking at forecasting that a huge downturn in New York. The market will be flooded with so much inventory that they're going to be overcapacitated for what people could afford to rent, right?
Well, it's so interesting because New York and Calgary have a similar problem, but New York has it for inventory of res. Calgary has it for office.
Yeah.
And it's so interesting to watch because there was actually a video that the mayor came on and pleaded for corporate headquarters to come to Calgary because they have something close to 12 million square feet of vacancy. Mm-hmm. They're just sitting on this mass vacancy. And while the oil companies are coming back with a vengeance, the price of oil is coming back, what isn't coming back is the opulence. And so it will come back eventually, but it's going to be several years to be able to burn through that inventory.
Yeah, it definitely. Oh, yeah. If not, maybe 7-8 years. If you want to get realistic with it, right?
Yeah, typically a business cycle is about 7 to 10 years. Yeah.
Yeah. Sorry, my daughter's birthday today, so she's coming in to check on me, and she's in the room here. Okay. So, anyways, it's my daughter's second birthday today. She's 2 years old, and she's and this is one of the reasons why I got out of the city, was because I wanted to lay roots and actually raise a family. I wanted to raise a family. I wanted the life that I lived as a child growing up, with not having to worry about if my parents made sure that I didn't have to worry if we had a roof over our heads. You know what I'm saying? And
absolutely. It plays a huge role in making sure you can actually afford a yard, a safe place to be.
Mm-hmm.
And the other thing that's so interesting about that is that the echo boom, the millennial, zennial demographic is having kids now. And you look at, a lot of the European cities where you never get into a house,
mm-hmm.
and you go, is that the lifestyle I want for my children? Well, in Vancouver, you don't really have a choice now with the affordability.
Yeah. Well, a lot of people are leaving and to greener pastures because British Columbia is beautiful. So there's a lot of places that you could move to within the province that are just absolutely good, but then people start throwing jobs. Well, you know what? How do you think jobs got to Vancouver? It's density and population. If there's enough people living somewhere, you got the manpower, you could start eventually expanding into other other projects. You know what I'm saying?
Yep, absolutely. I mean, most institutions believe that once a city has cracked 100,000 people, it's deemed a diversified economy and stabilized. I would argue that's probably closer to 500,000 people.
Yeah. So now my question is, I know you own right now. So are you selling?
I am selling. I am deleveraging actively. I'm in the market, and I'm doing that for good reason. And it's not necessarily because I expect a crash, but there's better yield in other places right now. And if you're looking at another 3 to 5 years, if there's a bad election, another 8, another 7 or 8, all of a sudden you're in a position where your yield on your capital, your return on your investment, just isn't the same here.
Yeah. Definitely. It isn't, because I think it's already hit a peak. And if anything, it's going to go down from here, right? I think it's too much hot air, too much low interest rates, too much free money, too much stimulating the economy, too much hot air. Lots of foreign money, lots of parked money. And I think what happened is it was just the recipe for disaster. It's the recipe for the perfect storm, right? And now with rates going up and people stress testing, the average Canadian proper that makes about 65 large a year, 70 large a year, doesn't have $200,000 to put down on a house, because that's what they're asking for right now. When I did a stress test through CIBC live on air, I did a stress test with Steve, one of my listeners, and we went through it, and we needed about $160,000 down to borrow $400,000.
Which is a really low loan-to-value ratio.
Yep.
Especially when CMHC is claiming they're doing 80% loan-to-value and 90% loan-to-value. Mm-hmm. That's where it gets so tricky is that the banks and CMHC claim that they're giving these high-ratio loans.
Mm-hmm.
But sometimes, let's just say that the value is debatable.
Yeah, definitely.
Sometimes they'll argue the value is dramatically higher, and that's how people are refining out all their equity out of their homes. Other times, and to be frank with you, on the conservative side, a lot of banks right now are actively underappraising. I just had a unit appraised literally this week, and it came in about $100,000 less, about 10% less than what I thought it would come in at.
Oh, wow. And so you got a 10-point decrease.
And when I talked to the bank and when I talked to the appraiser, it came down to, no, we know the comps. You showed us the comps. We agree with your comparable sales. But the bottom line is, right now, we're nervous about the market, and we don't feel comfortable recognizing the full value of your property.
Exactly. And Steve, that was on my show 2 weeks ago, told me the same thing. He's got an appraiser friend that goes out and appraises, foreclosures for the bank.
Yep.
And they're all taking 10 to 15 points right off the top.
Absolutely.
So now...
And it's ironic because you start looking at that and you go, well, are they creating their own market? A lot of value in stocks, a lot of value in real estate is a matter of faith, right?
Mm-hmm.
It's a matter of belief. And if you have newspapers spouting articles about how the market's going to collapse, if you have bankers pulling back on financing and LTVs, all of a sudden that entire top end of the market just dries up. Because, like we talked about earlier, there's a pyramid attached to sales, right?
Right.
And ultimately it comes to affordability. If you're in the top 5% or top 10%, you're, I guess, first of all, more likely to be able to afford something at a grandiose scale, or multiple properties for that matter. But when all of a sudden the other 90% isn't able to actually even get into the market, that's a problem.
Yeah.
Now you have a bit of a Jenga situation.
So, but what we're targeting... But we're talking middle class now. We're talking once the middle class stops purchasing and selling from each other, you got a big problem, buddy.
Exactly. There needs to be depth to the market. If there isn't depth to the market, then ultimately you're going to have a real issue ongoing.
Because any average person could go out and open an investment account and buy one share in some oil company for $25, right? But when it comes to buying real estate, I mean, when the middle class can't do that anymore, we are looking at a huge problem, because the people that sell, let's say a lot of people sell off an estate sale, a family member dies off. Well, they sell it, and who could afford to buy it if there's nobody there to buy it, right? That's the question. Who could afford to buy it?
Well, and who can afford to debt service it, and who can afford to rent it? I mean,
it's not just, there's a huge scenario here.
The market in Vancouver is rentals. And you go, okay, well, if I'm buying a $700,000 investment property, a small 2-bed or a large 1-bed apartment,
mm-hmm.
and even if I have $200,000, $250,000 in equity into that, my debt service after strata is going to break even at somewhere between $2,500 and $3,000 a month. Well, most people can't afford $2,500 to $3,000 a month in rent. And even if you have a dual income earner going at that, such a significant part of your earnings is going towards rent. You'll never be able to save for down payment.
Well, no, you can't, because the thing is, the average, for example, in Sydney, it's like 17 times your annual income right now. That's how expensive it is in Sydney. It's like, it should be anywhere from 4 to 6 times your annual income, not 16 times, right? Same thing with Vancouver. It's a crazy whopping 14 times the average income. And in Toronto, it's a whopping 17.5 the average income.
Well, it's interesting because you start looking at history, right? Patterns of history and cycles and ups and downs. Well, at this point in time, we're at the peak of a 7-year or 10-year business cycle. We're at the peak of a credit cycle. We're at the peak of a hard asset cycle. So most people don't know about this cycle, but hard asset cycle transitions usually as a result of inflation, but not always, where you transition towards paper assets.
That's right.
Every 20 years or so.
That's right.
To try and mitigate the short-term impacts of inflation. Now, once inflation becomes significant, then assets like gold and real estate become attractive again. But during the transition period, they're not.
No. Do you think we're in a transitionary period right now as we speak?
Well, it's tough because I don't want to be saying sell real estate and go to stocks, because the stock market's overvalued right now because of the 7-year business cycle. But I'd say that we're heading in that direction.
Okay. So I got this article open here, and it's a really good one. So I'm going to read a bit of it so you could see here what's happening according to Better Dwelling here. And this is a really good article I really want to share with you guys. Greater Vancouver condo market is quickly changing. Real Estate Board of Greater Vancouver numbers show July saw inventory surge, then rise in inventory was met with big declines in sales. releasing a lot of pressure for prices to rise. Condo Vancouver prices fall for a second month. The price of a typical condo apartment made a slight decline, reported a condo benchmark of $700,000 in July, down 0.5% from the month before. That works out to be an increase of 13.6% compared to last year. Monthly declines occurred 70% of REBGV regions, but all markets were positive. Yo.
So there's some interesting nuances to that. So right out the gate, about a year ago, I think the last time I was on your show, we talked about the high-end market. And the high-end market is usually an early indicator of the market softening.
Yes.
We talked about how North Vancouver, product over $3 million, had slowed in its sale dramatically, down to about 1.1 per month. At that time, there was about 100 units in that classification evaluation on the market. So we had like years of inventory sitting there at the rate of attrition that people were buying these assets. And instead, that was a sign that the market is already softening. Now, we're starting to see it funnel down to the more common assets, right? The assets sub $1 million. Specifically, the volume is more an emotional metric. It's not a financial metric. It's not something that actually is an indicator of the market moving. But what it is an indicator of sentiment.
Yes.
It's an indicator of people going, I either want out of the market right now, which is why supply is going up, or, oh my God, every newspaper is saying the sky is falling, I'm not going to buy.
Right.
So the rate with which people are buying drops. And that fraction is what drives this volume metric.
I want to ask you something.
What actually affects the price, it comes down to a couple of variables. It comes down to the average holding power of an owner.
Yep.
And that's the amount of cash that they're receiving in rent or stabilized cash flow. Their alternative investments where they could put their money to get a better yield. And the last one's kind of an interesting one, but it comes down to refinancing.
Yeah.
So in the U.S., when the big crash happened, everyone was on a ninja. They had negative equity in their house.
Yep.
Everything just cratered all of a sudden.
Oh, lock boxes on doors.
And it snowballed on itself hugely. But in Canada, because of personal covenants on mortgages, and because of the fact that most owners have, say, owned an asset for 2 to 3 years and seen 20 or 30% capital appreciation in that period of time, a lot of these people have staying power. And you have a pent-up demand of an entire generation of people that have been trying to get into the market for like 10 years and just couldn't quite get there.
Well, yeah.
So
I was one of those people. I was one of those. And I said to myself, it's not that I can't afford a $2 million house. It's, do I want to spend that much on a plain Jane ordinary house? Exactly.
So there's this pent up demand there. So will the market soften? Probably. Will it soften dramatically? 5-10%? Sure. I wouldn't bet against it. But if you're talking 20 or 20% plus, I'd say highly unlikely. Because the second that the market drops a material amount, there is multiple buyers that are licking their chops to get in, that have been trying to get in for years.
That's correct.
In addition to that, you have a ton of patient money. A ton of money that is all hypothetical gains, but they haven't actually lost any real money because the market went up 20-30% in the last year or two. So, yeah, I mean, there might be some people going, I want my capital, I want out. But there won't be a ton of people saying, oh, my God, I'm losing my shirt.
You don't think... So, with the whole stress testing thing and the whole, everything going on, you don't feel it? You don't feel the eeriness in the air? You don't feel that, like, we're in for the calm before the storm? You don't feel like there's going to be a huge dramatic change?
I think if interest rates spiked to 6% and we had this perfect storm, yeah, you'd probably be right.
Okay.
But realistically, Vancouver has always been a staircase, and there's reasons for it. There's structural reasons for why Vancouver goes flat and dead, but doesn't really crash. It's not like Calgary, where it's a boom or bust city. It never has been.
Okay, can I ask what? Okay, like the dangers right now are that and what's happening in Toronto is that the detached market is catching up to the condo market now, and in some cases, and then that's becoming the condo market. The price of homes. The condo market's catching up to the detached market is what I meant to say. I'm sorry.
And that will, of course, correct. It will, of course, correct. The detached will always have a premium to strata. But the catch here is, on that basis, why is Westminster trading at 15 or 20% discount to most of the surrounding municipalities? It should be. It should be trading at, less than 10 based on historical standards. Mm-hmm. But for some reason, New West just never took off the way the rest of the market did.
There was a lot of fears in the American markets. You remember because this month or last month makes a 10-year anniversary that the markets crashed in the United States. It's 10-year anniversary, right?
And especially the end of the 10-year business cycle.
That's Absolutely. Right. That's right. But you got to remember. We have a lot of problems. A lot of people have a lot of problems trusting any markets right now. Even a 10-year, a lot of people are out. The average taxpayer in the U.S. had to pay, I think it was roughly $64,000 per person for that bailout.
Yep.
I think it's average, $60,000 per person. It cost every man, woman, and children in the U.S. It was a huge proportionate amount, apparently, and that's a lot of cake, buddy.
Oh, absolutely. The thing is that our market inflated? Yes. Is it structurally set up to have more of a backbone than what the states have? Mm-hmm. Yes. We are a safety net country. We're designed that way. We have one of the more conservative banking policies. We have personal covenants. If it defaulted, if the market dropped in excess of 20%, which would mean you're now into private mortgages. Now you're not even in insured mortgages. You're in private mortgages. Yeah. If it dropped beyond that point, it would be devastation. And I say that in a joking way, but I mean at that point in time, banks actually start losing balance sheet, and it isn't going to happen because they have the right to chase you and garner your wages for years afterwards. Mm-hmm. You default on these mortgages. It's not like in the States where you can run
Jingle Mail
mortgage,
Jingle Mail,
and basically a year or two later your credit is fine.
Jingle Mail is when you mail your keys into the bank.
Yeah, and I mean that's not the way Canada's set up.
Mm-hmm. So okay. So let me touch on the bad deals. Okay, let's talk about bad deals now. There was a lot of packaged bad deals that a lot of underwriters approved. A lot of lenders lied on the TDS to get loans approved. A lot of lending institutions broke a lot of rules to approve deals that were hindrance to the customer. A hindrance in their lives, and it's turning into a lot of nightmares. And you see a lot of banks having to pay back have to pay back a lot of the mortgages that they put on the books that are absolutely garbage. Does that play an effect? So are you referring to the subprime debacle in the States, or you're referring to... Oh, we're talking about Canada. We're talking about the major banks that put a lot of junk on the books recently. And a lot of underwriters are getting scrutinized, and a lot of lenders are lying. The lenders themselves are lying with pay stubs and stuff, and making up numbers so the TDS would fit. But it goes against the bank standards. I'm talking about a lot of the junk that's been put on our books. I've read quite a few articles from all the big banks that are being held accountable for this garbage.
Now I wouldn't deny that there's a huge financial incentive when the market starts drying up. And you have mortgage brokers everywhere, you have realtors everywhere. People scramble, people reach, people stretch the truth to qualify. And it's just human nature, right? You're looking out for yourself, your family. You want to make sure you pay your bills. Mm-hmm. The problem with it is it's not a systemic issue.
Mm-hmm.
It's a one-off here and there, and the reason why the states had such an issue is because they cross-collateralized these things, threw them in a giant fund.
That's right.
And,
yeah.
That's how you came up with CDOs and things like that. Is because they deemed them diversified just because they were put into a fund geographically diversified.
Mm-hmm.
But the bottom line is that the quality, we don't off-put our book as much as the states did in the past.
Mm-hmm.
Most banks, yes, they insure, but most banks don't unload a ton of their mortgage book into the public markets. You don't see the same level of third-party carrying.
Yeah, that's where they package them and they set them off, and then they packaged up bad debt and stuff, and then let people basically, yeah.
So as a result, the banks actually had a financial incentive in Canada to remain somewhat diligent versus the states that just, I'm going to sell this to someone else on Monday.
Mm-hmm.
So it's a bit of it's a different structure. Again, it's a structural difference, which is why, could the market drop 10%? Absolutely. 20 plus? Highly unlikely. The Fed would take action before the market dropped 20 plus.
Well, the U.S. Feds have been raising interest rates to create a buffer, right?
No, but I'm not just talking about the Fed in the U.S. I mean the Canadian.
Okay. Yes.
Would go in and take action. I mean, if the market dropped that severely, the politicians would be scrambling to find a way to inflate it again.
Definitely. Now, do you think Canada waited too long to raise interest rates?
Yes, but that's, from my perspective, largely due to unionized labor force in Southern Ontario.
Okay.
Effectively, the only reason our interest rates have been kept as low as they are is, one, because we have to stay somewhat close to the United States. But two, is because a lot of the heavy industrial services and heavy industry needed that to stay competitive. And believe it or not, Ontario has a pretty significant pull when it comes to politics in Canada.
Yes, they do. They're pretty much very strong with that. They have a huge leverage on their side. They have the weight on their side if you're on a teeter-totter, right?
Yeah.
So now, where do you see things in Q1 of 2019 in Canada?
I think anyone who's selling quote-unquote luxury product in Vancouver, that would mean anything over, say, $1,200 a foot, $1,000 a foot for concrete,
mm-hmm.
and for most of BC, it would be $600 to $800 a foot. Anyone selling product above that is in for a long, slow stint, and they're gonna be sitting with inventory on their new product. The problem is that, well, the nuance of it is that inventory doesn't come on because if you don't have the pre-sales on a large-scale development, all that happens is that everybody just sits on the project and can't go forward. Because everybody finances on the construction through, banks and things, basically, if you don't get the sales, 20, 30, and, for some more aggressive developers, you need 50% pre-sales in order to be able to get your construction financing.
Mm-hmm.
So what will happen is that the guys who have inventory will sit, and the guys who have land that are thinking about building won't promote to sell.
Of course. Where do you see construction headed towards Q2 and 3 in Canada? Because obviously winter time, our construction goes down to pretty much to indoor renovations, but then Q2 and Q3 in Canada 2019, where do you see construction heading?
So from a labor perspective, and this is just a guess, to be honest with you, I don't have a great deal of data to back this up, but from a labor perspective, it's been a heyday for the skilled labor for the last 2 or 3 years.
That's right.
They've been systematically pushing up wages. In the city of Victoria, the average handyman wage has gone from $35 to almost $50 an hour in a year and a half. Well,
Yeah.
you start looking at it, you go, okay, so will it crater? No, because you got all the boomers retiring. So the boomer offset is going to help. But do I expect wages of a particular skill set to go up in the next 3 to 5 years?
Mm-hmm.
I think it'll actually soften a little bit.
Okay. And Q1 condos. What do you see happening Q1 in condos in the city of Vancouver? Well, let's touch on Toronto. Have you been following Toronto? They got a 40% decline.
Yep.
Now, how do you? They're okay in Toronto. They are assessing it as an anomaly. What's your perspective on that?
Toronto boomed and busted because of a lot of institutional money, because of a lot of consolidated funds, and because of a lot of foreign money. The fact is there is some legislation that's being put into Ontario specifically attached to rent controls and things that make it more difficult to convert standing inventory of strata and market condo to rental, because it's more difficult to get it back. The province of British Columbia was considering a similar legislation, but hasn't gone through with it yet. But if you look at Toronto right now, if I put a strata unit into a rental pool, that rental rate potentially can get locked in to the unit forever. So it's not locked to the tenancy. So I mean, right now the rental unit market, there's these basic ceilings, these caps. But in BC at least, when your tenant's done, when your tenant moves on, you can bring it to market. In Ontario, that doesn't happen.
No.
And so your options are sit on a bunch of empty inventory and hope that the market comes back, or what? Because you can't really cash flow. You can't really stabilize yourself with cash flow through a rental methodology.
Mm-hmm.
So that's why you're seeing a more severe drop there, in my opinion, than you are in British Columbia. I mean, and again, this is an opinion. And my opinion is that this legislation has a significant impact in the ability to hold, and someone's holding power when the market goes stale.
Yeah, the patterns are there for that, definitely. For your opinion, I think is very, very spot on, because a lot of the patterns that you mentioned are there. A lot of it's plain as day if people could read through the lines, right?
Yep.
So now the detached market now. So the condo market is reaching levels of the detached market in Toronto, where you're seeing homes in Richmond Hill, Ontario, were at 1.6 million, and then they're going for 900,000 now. So
you will see compression in the multifamily market in that particular market. It just will take longer.
Mm-hmm.
Because ultimately, like I said, all markets correct their natural state.
I got a question here in the live stream chat. Baby boomers ruined everything. Is that what do you see in the boomer market?
Well, boomers haven't fully downsized yet. They're working far longer than they were supposed to.
Yep.
But if you were to say, yeah, are they ruining everything? I wouldn't go as far as saying they're ruining everything, but they have set up a series of problems for us. And if you are wondering what our country could look like if they're not handled properly, look at Japan. Because their demographic hit that seniors level years ago. But back in the early 90s, Japan was booming. They had Japanese businessmen coming to Whistler every weekend. Things were blowing up. They had money. They were doing really well. And then as the demographic aged, and a variety of other financial contributors, you saw a softening. And it continued, and it continued. And it's still, 20 years later, dragging down that economy.
Mm-hmm.
So, demographically, given that they have limited savings, most of them, and that they're hoping their house value is what becomes their retirement, we may see a softening in the detached market in the next few years. A lot of reverse mortgage packages I could see coming on in the next few years to try and basically have them transition out of the housing market and use that savings for their retirement.
Interesting. So Okay, let's go back to what my original questions were. So Q1 condo market Vancouver, what do you see?
Q1 condo market, I think it's going to be slow. I think you're going to see a slight decline in pricing, but I think I think volume is going to be where you're really going to see it. It's going to stay slow for, I'd say, another 6 months to a year.
Okay. I know you're not too familiar with the New Zealand and Australian market. What do you think of them? I already asked you that one about New Zealand, but what do you think of Sydney losing a huge 1.5 to 2.5% every quarter? London, UK, same thing. London, UK is bottoming out. They're going 18 straight months in 0.5 to 1% every quarter loss in London proper. We're seeing huge declines in. Obviously, we mentioned Toronto, but it's so interesting how everyone's running to in the country. Like, for example, Sydney got out of control. Everyone moved to Melbourne. Melbourne got out of control. A lot of people started moving to Hobart, which is Tasmania. And now that's bringing up the property values there too. So it's kind of interesting how in Canada, everyone's fleeing the big cities and moving now, like they're going to Quebec now. Because Quebec, you can still buy a median-sized family home for around $265,000, right?
Yep.
So what is happening? Is it intermigration of people moving to different cities and causing these inflationary bubbles? Or is it the foreign investors jumping on the next big thing, or jumping on the next ride, or taking the next roller coaster? What exactly is this? Is it intermigration? Is it I believe in my heart of hearts that a lot of young people want to start families, so they're moving to smaller towns like myself, and I could prove it to you. Like, half my street is from Vancouver, and it's all young families.
You kind of have asked three questions there.
Okay.
The first one is the international one. Right?
Yes.
What is happening internationally? And to be honest with you, if you look at the average person's access to leverage, because, I mean, don't get me wrong, institutions can leverage 10, 12 times on a stock market acquisition and be very tactical about it and make great returns.
Right.
But if you were a mom and pop, an average investor, how do you get leverage? The best way to get leverage is real estate. You can get, 70 to 90% if it's insured.
Mm-hmm.
So all of a sudden, the interest rates cratered in 08. People made a ton of strategic actions to try and mitigate, the market falling apart. And as a result, we have this legacy where a lot of people are highly levered, highly invested, and want these low interest rates.
Mm-hmm.
All of a sudden, you go, okay, well, I made a big run, I've made a big return, but my cash flow is awful, my retirement return is awful. Slowly, people start going, okay, well, as my ability to access leverage decreases, and as my cost to carry that leverage increases,
yes,
I am less and less attracted to assets like real estate, and I'm out.
Okay.
So it's 2008. Let's call it echo wave.
Yeah.
In terms of the family thing, absolutely, that's been going on for 3 to 5 years now.
Yeah.
5 years ago, I would have been like, buy townhouses. Demographically, it makes sense. Well, townhouses now shot through the roof. Mm-hmm. And so your options now are, well, I can't really afford a townhouse. What about a 2-bed? Well, now 2-beds are right off the edge of the affordability matrix for most people. Given the interest rate today, most people with a good down payment can maybe get to $700,000. So, and that's with a stretch. That's with a good down payment. That's with, two working parents. So you start going from that perspective, and you go, okay, well, if I have a choice between a small house and a smaller community, or at best a 2-bedroom where I'm going to have to house my 2 kids, the decision's kind of easy.
Yeah, yeah. I don't know if you watched the video I did with the Douglas Todd article where the demographic. Douglas Todd is about demographics, and he's talking about how in 2016 cycle, the whole year, I think it was 12,000 whites have left Vancouver and 590 Aboriginal people have left Vancouver for the interior of the province. And then 2017's numbers are anywhere from 16 to 24,000 white people, and I think it was 1,400 Aboriginals have left the Lower Mainland to other parts of the province. And this is where you're seeing spikes in Kelowna. Kelowna is spiking out of control. Kamloops is cooling off a bit right now. Then you got cities like Salmon Arm, and you got cities like other cities seeing huge increases right now.
Victoria's seeing double-digit growth.
That's right.
Believe it or not, all the big developers from Vancouver are over here in Victoria. You know, you got Boza here now. Chart is coming in with big institutional money behind them. You got Salient moving over. I mean, a lot of the mid-sized developers especially have just gone, I can't afford the land or the land banking requirements for Vancouver anymore. I'm going to go to another city, and the next biggest city is Victoria.
Yeah, and I heard that the zoning laws and the don't take us to rezone an area doesn't take a million years. They do it within a few months. And I heard that
Langford, yes. Other municipalities are a very different story. Good luck at getting something through in Oak Bay.
Yeah, yeah. Okay, so the third question that I asked was, so we talked about boomers, we covered the condo. So, okay, detached market. Do you see the detached market still declining?
Sorry, just one more time. What was that?
Do you see the detached market decelerating, declining, detached? Been going down for a good while now.
I think as long as it's out of reach of the average dual income, yes.
Yes, the Canadian proper, or AKA middle class, or AKA working poor, right?
Well, and I say dual income. When I say dual income, I'm referring to the 30-year-old couple that has a dentist and a consultant as a husband and wife, right?
Mm-hmm.
Because, you know, still technically the upper end of what should be the middle class.
Mm-hmm.
Those people are the ones who have been waiting to get into the game.
Mm-hmm. Mm-hmm. So, do you ever read Better Dwelling?
I do from time to time, yeah.
Yeah, Better Dwelling's pretty good. They get some pretty good graphs up there, some pretty good visual things for people to see, and they got a pretty good article right now floating around that I'm looking at. Tyrannet, you know Tyrannet, right? Canadian real estate prices continue to decelerate, smallest growth since 2009. And that's some big words there. I mean, if they got to back that up, I mean, this is every investor's worst nightmare is Better Dwelling, because they say it how it is. And once you start getting on some of the mainstream media, they start twisting things and kind of twisting facts to help massage and calm investors. How do you see the media playing a part in this whole housing situation?
Well, let's just put it this way. I wouldn't trust your newspapers. And I know that sounds like a conspiracy theory thing to say. And believe me, I am anything but that. But I can tell you this. The newspapers, Vancouver's newspapers' largest single contributors to ad space. Open up your newspaper for the last 3 years. Mm-hmm. What do you see? It's condo project after condo project.
Oh, yeah, you see coming soon, the luxurious glass, the glass tower, the new Olympia, the new maritime condos, the new España, the new Lisboa. Yeah, I see it all the time.
And not to say that they would ever diminish their journalistic integrity, because we do have quite a high quality standard of writing throughout Canada, and we don't really have a filter on most media forms. Mm-hmm. But I will tell you that if I were a newspaper owner and my largest single ad contributors were there, and we already know the press is getting pinched dollar for dollar, penny for penny, I'd be doing everything I could to help my clients.
Oh, for sure, especially when they're trying to unload condos and all that, you know.
Well, back in 2008, what was particularly interesting was the Ani bulk sale. I don't know if you ever heard about that. Yep. But Ani was convinced that the sky was falling in 2008, and they did a bulk almost 20% discount of all their product on load, thinking that they'd be in a cash position to be able to buy up land cheap when the market crashed.
Mm-hmm.
And ultimately, it never crashed to the extent that they hoped it would. But, I wouldn't say that you're not going to see that pretty soon.
Okay, I got one more last very important question for you. What do you say about people walking away from their down payments and deposits? That's happening a lot in Toronto, and it's happening a lot in other cities like Barrie, Aurora, Ontario, Ajax, Ontario, Hamilton, Ontario. People walking away from their deposits. What's happening?
Well, at some point in time, you lose faith in the market, and if you only need a 5 or 10% deposit, depending on what stage your deposit you're at, because some developers allow as little as 5 for the first few months, which generally trends up to 20 or 25 towards the end of the project. But if you're early phase in a project, you only have 5 or 10% in, and the market's course corrected 5 to 10%, and there's no legal recourse for them to take beyond the deposit, yeah, that happens. Ultimately, that'll cause default sales that I'm telling you about.
Do you see a lot of people walking away from deposits in Q1 of 2019?
Well, I don't want to get into too much detail because I was actively involved in a deal like that in 08. Mm-hmm. But I will say that in 08, there were several towers that were in financial trouble. And one in particular I was working on. It got to a point where people were actually claiming that the shift in the market and the change in the ability to finance that deal was a material defect, and they tried to get out of their contracts.
Mm-hmm.
So they lost in court, but it was a long, hard fight.
Okay.
So read your pre-sale contract carefully.
Yeah, guys, if you're getting into pre-sales and they're not breaking ground, and what do you say to people that haven't... Oh, I want to ask you this one. I read an article a few months back, and it was really sad that a lot of people were giving back their deposits because the price of the housing went up a lot more on a pre-sale, and they're starting to break ground, and they're saying, well, we're going to have to give you back refunds. How does that work? Why is that fair? How is that even fair when you walk away from a deal, they sue you, but when they deny you to sell you the item after you sign on the dotted line because it went up, and they just give you back a refund? How does that work? Why is that... why can't it be a two-way street? You know what I'm saying?
Well, right out the gate, most of the purchase and sale agreements that are structured through those developers are designed so that they do have the right to exit. So again, read your purchase and sale agreement carefully. But the other thing to consider is that ultimately a developer is supposed to, a savvy developer, is supposed to lock in 70 to 80% of its costs prior to ever really selling. Mm-hmm. So savvy developers go and get fixed price bids from contractors. They lock in their materials. They basically pre-buy their materials, and a supplier winds up getting some sort of derivative hedge to mitigate the time exposure of rubber or concrete or whatever. Mm-hmm. So the curse of it is that in this particular example, and in several others, what likely happened was he didn't properly control for his costs, and he couldn't afford to build the building at a loss.
Yeah. Okay.
So your options are have an Olympic Village where, literally they had to blow out inventory and, half the units were like slapped together.
Yep.
Or have the guy go bankrupt building and stop halfway through, or get your deposit back and hopefully find somewhere better.
Wow. Yeah. Anyways, we're coming up to our one...
Guys, I gotta go.
It's our 1 hour now. Our 1 hour is coming up. Mr. X, I want to thank you for all your professional insight on the markets and where things are headed. I'll have you on the show, I guess, when you're free next time, and we could discuss where things are headed, hopefully soon.
Thanks so much. Talk to you soon.
Thank you so much.